Right, the consolidated statement of changes in equity. Now, I know that the consolidated statement of changes in equity feels like the harder one to do, but if you practice this and you focus on being able to only prepare the consolidated statement of changes in equity without first having to do the SPLOCky or something else, you'll get used to it. You just need to understand where these amounts come from. And the only thing that makes it a little bit more complex is because you have two columns and the amounts of the subsidiary ends up in both. And that's why we prepare the analysis of equity. But if you're able to prepare a proper analysis of equity and you know which amounts moves where into the statement of changes in equity, it really becomes quite doable. And that's why I spend so much time on the timeline and then look at the analysis of equity again. Because once you've done that properly, all the hard work has been done. You just need to know where those amounts from the analysis fit in when you do the consolidated statement of changes in equity. The NCI column, we've really spoken a lot about this already. Your at acquisition two amounts plus the since to opening balance amounts flows into your opening balance. If we just look at calculation G quickly, the 52,000 Rand was the fair value in the ordinary shares. The 75,000 Rand was the fair value in the preference shares at acquisition date. And then since to opening balance, remember this from the timeline. There was two amounts, the 33,000 Rand and the 6,000 Rand that you've attributed to NCI. It's done, it's there, it's in the timeline, it's in the analysis. Get it from there, add it together, and you have your opening balance. We already, when we did the two journals, profit attributable to NCI, concluded that the profit attributable to NCI is the 42,000 Rand comprising of the 36 and the 6,000. Two journals, two analyses added together. And here you now see the effect of that debit leg of the intra-group elimination journal entry of the dividend, the debit to NCI's column. Just a quick reminder from the analysis of equity. When we prepare the retained earnings column in the consolidated statement of changes in equity, NCI, we know it's all the amounts coming from this column. But when you're working with retained earnings and later on other equity items of the subsidiary, the amounts in this column attributed to P, the owners of the parent, these are the amounts that you end up adding to that of the parent, representing the amounts of the subsidiary attributable to the owners of the parent. So when you look at the calculations at the bottom of the statement of changes in equity, the amounts you keep on adding to that of the parent for retained earnings in the group are all the amounts coming from this column over here. Back to the statement, the retained earnings column, as I've said, that is the equity attributable to the owners of the parent. Your opening balance, let's use the analysis now to get to that amount. You start with the opening retained earnings of the parent. It's in the TB. Then you add to that the 77,000 Rand, as I've just shown you from the the ordinary share analysis. And remember, the moment you are in chapter 8, it's not only a portion from the ordinary share analysis, the parent is also a preference shareholder. Therefore, there's also an amount coming from the preference share analysis that they are entitled to, that is attributable to them, that you add to their opening balance. If you had a gain from bargain purchase in this example, and then I say gain from bargain purchase as a net amount. We did have one in this example, but it offset against the goodwill. Then this is where you will add the gain from bargain purchase. Please note, you're adding it to this total. You're not adding it specifically to that of the parent. You're adding it to the retained earnings of the group. Still looking at retained earnings, while it's in front of me, the dividends declared will only be that of the parent because we eliminated that full 30,000 Rand dividend declared by the subsidiary. The subsidiary didn't have any ordinary dividends, but even if they did, we know it will not end up in this column. Last one is this 219,000 profit. That is now the profit of the group. That is calculation L. And to show you how we use the analysis for this, we start with 100% of the profit of the parent. We eliminate from that the 12,000 Rand dividend income. You remember when I showed you the analysis, you see that amount attributed to the parent as the dividend income that they have recognized that have to eliminate. And then from the ordinary share analysis, the profit attributable to P was the 84,000 Rand, and the profit attributable to the parent as a preference shareholder was the 4,000 Rand. The 10,000 times 40%. Again, remember from chapter 8 that you now have two amounts that you keep on adding, either to the equity attributable to P or to the equity attributable to NCI. Two amounts every time, every line item, depending on the given scenario. Wrapping up example 8.2, we look at the consolidated SPLOCkie for the year ended 31 December 2010. The only line item available is profit for the year. We give effect to 100% P plus 100% S, my single economic entity principle, and adjust that for the consolidation journal entries. The only intra-group consolidation journal entry in this example was the dividend income recognized by the parent that has to eliminate as its dividend income from a dividend declared by the subsidiary. At the bottom section, we always attribute to my equity participants. Now your non-controlling interest will comprise of two amounts, the profit attributable to the NCI ordinary shares plus the profit attributable to the NCI preference shares where and if applicable. We balance back to the amount attributable to the owners of the parent. You've seen this amount now in the consolidated statement of changes in equity, and when we looked at that, I've showed you that you are also able to calculate that amount. But when you do the consolidated SPLOCkie, do the line items up until profit for the year, calculate profit attributable to NCI, and balance back to that of the parent. No OCI items, therefore the bottom sections are the same.